Okay, welcome to our recorded lecture on taxation of companies based on the new Act ITA 2025. Okay, so we have seven learning outcomes here. One is identify residency criteria for companies based on incorporation and central management control. Apply permanent establishment test to determine tax liability for non-resident foreign companies. Compare standard corporate tax rates, non-resident and superannuation fund entities, evaluate the 50% ownership rule for carrying forward corporate tax losses, explain legal requirements and mechanics for transferring tax losses between group companies, analyze tax neutrality relief for asset transfers during corporate reorganization and restructuring, and then determine income tax treatment for transaction between mutual associations and their members. Okay, so the residency test for company is under Section 6. It's almost the same with the old standard or old legislation, wherein to be considered as resident, it should if the company is incorporated or formed in PNG, so that's automatically a resident taxpayer, or it has the central management and control in PNG, or it's a prescribed unit trust or landowner resource trust, or it's a superannuation fund that is established or managed in PNG. So this is a residency test for company. Now the new act had created this clarity on permanent establishment. Now in permanent establishment, it means that there will be a different uh, treatment on non-resident company. Okay, so in this case, we will use this test. Okay, these are the corporate presence tests of under the permanent establishment. One is maintaining a branch, office, factory, or workshop in PNG, a building site, construction, assembly, or installation projects that exist for 90 days or more in any 12-month period, providing services including consultancy through employees or other personnel for a total of 90 days or more within the 12-month period, having any person in PNG who has and habitually exercises the authority to conclude contracts in the name of the foreign company. So these are the tests. Just one of these will be used or can be used as a criteria of the permanent establishment. So why is this important? It is because the taxation will be different when it comes to a company which is a non-resident but has permanent establishment here in Papua New Guinea. So the tax of the permanent establishment or company with permanent establishment will be 30%. Same with the resident taxpayer. Uh, so the old foreign contractors withholding tax, so we don't have it, or we are not have that emphasis here now. Okay, so it says here, uh, uh, before the foreign contractors withholding tax, we don't allow that business expenses. Now we are allowing it as long as it's from their PNG sourced gross income. Okay. So which means we have to determine if that revenue or gross income is generated in PNG. Another thing, or the new one is aside from the corporate income tax of 30% for a non-resident with permanent establishment here, there is a 15% branch profits tax for what we call repatriated profit, which means that is the profit sent to the foreign home office or head office. So it's a non-resident company, but they have permanent establishment here. They will be taxed 30%, but any profits that they will send to the foreign head office, that will be taxed by 15%. Okay, this brings the tax treatment of a branch or permanent establishment branch in line with subsidiary, okay, which pays CIT plus dividend withholding taxes, almost the same treatment. Uh, Another one is an on anti-avoidance. Okay, So new obligation for non-resident companies, if they have permanent establishment here, their administrative responsibilities will be foreign companies must register with IRC and obtain a tax identification number. So automatically they will need to have that tax identification number. Companies must file an annual return showing the calculation of net profit. The IRC now has the power to estimate profits if records are insufficient. So if are unable to provide proper documentations or sufficient documentation, IRC will be able to estimate the profit. The transaction between PNG permanent establishment and its foreign head office must be conducted at arm's length transaction. So when you say arm's length transaction, it should be within the normal or the norm, and not too much pricey or not too cheap. Okay, so IRC will scrutinize the head office charges, or if that transaction is sent by the head office, or management fees to ensure profits aren't being artificially shifted out of PNG. So they're trying their best, or IRC has the power to reduce the risk of profit shifting. Okay, more of the profit shifting on tax planning. We will have a special discussion on that. All accounting records necessary to determine the PNG taxable income must be accessible for IRC audit. Now it says here presence equals profit tax. Okay, if a foreign company stays in PNG for more than 90 days, it's automatically they have a permanent establishment. It is not treated as a visitor now, or yeah, visitor, but now they are treated as taxpayer. Okay, the rate, you can visit IRC website later. I'll show you that website too. So this is the rate. Okay, for commercial banks, there are a specific provision in ITA to 2025 with regards to the rate percentage. As you can see here, in 2026, the tax will be 35% if the profit of the commercial bank is under 300 million. And then it will go up to 43% in fiscal year 2026 if the income is over 300, or the taxable income over 300 million kina, okay, and so on. So which means that's the excess in that case. Okay, under section subdivision 4, section 64, company is treated as a separate taxpayer from its member or shareholders, which is consistent with Companies Act, okay, 1997. So which means if the company is treated as a separate taxpayer, they have to pay their own tax. Now, with regards to loss, of course, the loss is difference between assessable income. If the assessable income is less than the allowable deduction, then that will create loss. And the loss can be carried forward. Okay? In carry forward, we have different sections here that you can refer to. If it is the ordinary net loss, that is under section 35. Foreign income, foreign losses, that will be under section 70. And any excess carry forward under section 101. Of course, they are subject to limitation, which we will go through along the way. Okay, another rule about carry forward loss. Okay, this is one of the limitations that we discuss. If there will be change in the beneficial owner, 50% or more of the company's membership interest, okay, then that is have a change in ownership. The 50% or more change in ownership will not allow the tax loss to be carried forward. Okay, but there's another one later we'll discuss. If this 50% threshold is met, tax losses from the years before the change cannot be deducted in years after the change. Okay, unless specific tests are met. So this one is the first test, which is the 50% ownership. Now, you've seen that word, beneficial owner. This is a good concept added in ITA 2025. This is the definition of beneficial owner under Section 5, subsection 1. Beneficial owner of a membership interest in an entity is the individual who ultimately owns the interest either directly or indirectly through one or more interposed entities, which means if he owns a direct interest on the company, okay, or if he owns a company with ownership of another company, okay, he will be the beneficial owner of that other company. Okay, let us say company A owns company B, but company A owns by let us say Mr. X. So Mr. X is the beneficial owner of company A and also will be a beneficial owner of company B, even though company B is owned by company A. Okay, that is what we call indirect, okay, ownership. Another one is controls the exercise of rights attaching to the interest or benefits from the interest through an agreement, trust, and any other form of influence. So it means that they still have that vested or benefits or interests or rights over a particular entity. Probably, let us say a trust. They still hold that rights on interest or benefits. Then they are the beneficial owner, even though the document is saying they are not the one receiving the benefit, but in reality they are the one benefiting from it. Then that will be a proof that this person is beneficial owner. Okay, so another test on loss carry forward will be aside from the 50% ownership, the company must prove it carries on the same business, or we call it continuity of business or same business test. So if there are chains and more than 50% of ownership, the next test is the business same or continuity of business test or same business test. Okay, so the requirement is pretty obvious. Say this same business must be maintained during the income year, which is that is taxable year, and also another one is all intervening tax years must between the last year and the income year. So they have the same business model. So these are two tests which are still consistent with the old act. Okay, anti-avoidance measure. Like the company must not engage in any business or investment if principal purpose is to take advantage of the prior loss. So they will be able to avoid or IRC will be able to stop any attempt of taking advantage of the prior loss. Okay, so they cannot just create a new business which can absorb the loss. Okay, the goal is to prevent loss trafficking, where a profitable business is injected into a shell company solely to use that company's all tax losses to reduce tax liability. So what does it mean? You cannot create a special purpose entity just to transfer your loss. Okay. Later we will talk about loss transfer. Okay. Which you will have an idea what it meant by this loss trafficking. Okay, compliance and reporting under Section 65, subsection 3, it says if a 50% or more change in ownership occurs, the company must notify the Commissioner General. They have to inform them that within 15 days, it should be in writing. All right. So this is the one that I mentioned about loss transfers. The loss of one company can be transferred to another company. Okay. Which you will notice I mentioned about loss trafficking a while ago. So here it should be clear that it is avoided or restricted to transfer the previous loss to a new company that you just created or a taxpayer just created to absorb the loss. Okay. So that's not allowed. Okay, there might be some clever guys who will try to circumvent the law, but that is already clarified under ITA 2025. Okay, the income company reduces its taxable income, which will be reduced by absorbing the loss incurred by another company. Okay, so This is the agreement. Okay, so of course, body, sorry, the company, it's a body or corporate. Representative, take note of this. That's a person authorized to act for the company. Of course, normally that will be the CEO or the chairman of the board. Okay? As long as they are authorized to act as the company, so which means if the board gave that power to the CEO to represent the company, then that's fine. Licensee, that is subject to special rules. Resident status, both company, loss company or the company who incurred loss and the income company must be resident companies. Take note that's the requirement. So non-resident will be excluded. All right, eligibility criteria. The loss company must have a loss under Section 35 for the current year. The income company must have taxable income for that same year. So they should be on the same year. Okay, it's not you have a loss now and the next year you created the company to earn income to absorb that loss. It's not like that. The company must qualify as group companies. So how to test these group companies? One company owns at least 95% of another company directly or indirectly. Okay, so that's at least 90%, 95%. Both parties must formally agree to the transfer. So these are the criteria that needs to be followed in order for the loss, a company incurring loss, to transfer it to another company which earns income. Okay, what's the mechanics under Section 66, subsection 3? Okay, treatment of income company. The loss transferred amount is treated as if the income company incurred the loss. Okay. The amount under the loss company, the amount is no longer considered a loss of the origin company. It cannot be used twice. So which means if you transferred it, then that will be absorbed by the income company. There's a limit. The transferred amount must not exceed total taxable income of the income company for that year. So which means if the income of the company is 200,000 kina and the loss incurred by another company is 300,000 kina, the maximum that the company with income can absorb is up to 200,000 kina only. Okay, so the transfer agreement, this is important. Agreement must be in writing. It must be signed by the representatives of both loss and income companies. So which means there should be a memorandum of agreement. And the document must clearly state which specific tax year the loss relates to. So that's part of the agreement when you will charge it or which year that tax loss or loss carried for or transferred is incurred and of course till when they will absorb. The agreement must be entered into before the income company furnishes its tax return to Commissioner General. So before you lodge the income company lodge the tax return, they have to submit this agreement to the Commissioner General. And then the Commissioner General has the discretion to allow further time if requested. Okay, of course, if you fail to do this, the loss transfer will be disallowed. Okay, special rules for licensee. Rules for loss transfer involving a licensee are restricted. General transfer rules only apply to licensees as specifically provided in Section 101. Okay. This ensures that special industrial or resource-based tax regimes are not bypassed through general group transfers. Okay, uh, let's go on to the reorganization issue. Okay, the corporate reorganization is where the company is actually restructuring their corporate or the corporation, and probably there will be some changes, some expenses, or some terminations of employment or contracts will happen. Okay, so the goal here under Section 67 on reorganization relief, to allow businesses to restructure without triggering immediate tax gains or losses, provided specific conditions are met. Because if you engage in reorganization, there might be some expenses or loss that you will incur. So this will be certain guideline, okay, for reorganization with regards to taxation. Okay, eligibility, the transferor and transferee who can apply for relief. The transferor, a resident company or a permanent establishment or of a non-resident company. So this is different from the loss transfer that we discussed a while ago, because here the non-resident company can be allowed to transfer or be a transferor as long as that has a permanent establishment. Same with the transferee, same criterion. The rule here says the transferor and transferee must be group companies in relation to each other. Now, certain addition to our discussion, asset specific conditions. Uh, if the asset is part of a pooling basis depreciation, all assets in that pool must be transferred together. So what does it mean? In the pooling basis, you are grouping them into one particular classification. So all the assets will be transferred together. If the transferee must be subjected to PNG income tax or capital gains tax on any subsequent disposal of the asset. If the transferee is a non-resident PE or permanent establishment, the asset is legally deemed a Papua New Guinea asset. Okay, under subsection 3 of the same section 67 on tax neutrality rule, for transferor, no gain or loss is recognized on the disposal of asset, because so which means if the transferor is sending those assets to the transferee, if they earn or supposed to earn a gain or loss, that will not be allowed. Okay. Okay, on the transferee's point of view, if how they will record the inherited value of the asset. So in depreciation pools, or the pooled assets or pooling of asset, if that will be acquired at written down value. If you can recall, we discussed this in depreciation discussion on taxation one. So that actually the written down value. So cost less accumulated depreciation. For a specific depreciable asset under section 37, acquired at the transferor's written down value. Okay, so that's how much the transferors recorded it at the written down value, and all other assets will be acquired at the transferor's original cost at the time of disposal. So which means original cost at the time of disposal. Okay, so you have to adjust some valuation there. Now in subsection 2 and E and subsection 5 of section 67, this relief is not automatic, which means both parties must elect to for this section to apply. It should be written. It should be in writing and lodged with Commissioner General. So the deadline is on or before the due date of the tax return in which the disposal is reported. Okay. But of course, Commissioner General can allow more time. Okay, so the last portion of the discussion, introduction to mutual associations. Section 68, it says here, mutual association will be society organized and operated exclusively for the benefit of its members. So, sort of like the savings association or a superannuation, which they focusing on or cooperative, they're focusing on benefiting only the members. Okay, so specifically, societies registered under cooperative societies and savings and loan societies under savings and loan societies 2015. All right, the mutual association is legally treated as carrying on a business for the purpose of income tax. All dealings between the association and its members are taken into account when determining the income tax liability of the association and also the members of the association. Right, let's go on to the transactions. Payments to members, that is supply of goods and services. Uh, Scenario when the member sells goods or provides services. Okay, so what does it mean? So the member is the one giving the goods, okay, or provided services to the association. For the member, that will be treated as their income because anyway they're selling, so they're earning. For the association, that will be allowed as tax deduction. If for the payment of members from members, so here the members is paying for the goods. Take note that is payment for the goods or services. The for the association, that will be business income. For members, that will be deductions. Okay, a few more items. Rebates and bonuses. The association pays a rebate, bonus, or similar amount back to the associate to the members. So in that case, that payment or the payments are allowed as deduction to the association, reducing its taxable income. For the member, that will be if the amount is additional payment for goods and services, that will be treated as income. But if the amount is a reimbursement of an expenditure, uh, sorry, if the amount is a reimbursement of an expenditure, which they already claimed as deduction before, then that will be classified as income. And that's the end of my lecture. I hope you learned something.